All right. Well, welcome to the Laps and Gaps podcast. This is Basil, and I'm here as always with Jack Stockert. We are talking about it's kind of a follow up to a podcast we did before. We're talking about SPACs going forward. There's obviously been a proliferation of SPACs last year and this year, used to take companies public for the most part. Um, they're an evolution of a blank check company. That were originally designed to give investors money to buy a company of any type and then run that company. SPACs have a few more protections than classic blank check companies if they're used appropriately. But in recent years, they've been really just used to bring companies public more quickly and using projections and generally looser risk controls um, to inflate their valuations, I think. And maybe it's just a new thing, and so maybe it's not doesn't have anything to do with any of that, but I'm dubious. There have been SPAC issues right now. We're on the other side of the hype curve. We're kind of in the valley, or we're heading towards the valley. And the issues that were obvious over time were that the incentives were all wrong. The sponsor was paid to close. The target was paid to close the deal. Success of the resultant transaction didn't really matter. The lawyers and bankers were paid to close, so there was no one really checking for fraud. The target and sponsors again were incentivized to close, and these were multi-million-dollar paydays that allowed them to retire just based on that deal alone. So they didn't have to live with the combined entity. And in a few cases, we've already seen management turnover where they won't have to live with the combined entity. I'm not sure about their payouts as a result of how quickly the management turned over, but because these deals were so bad so fast. So we'll see. And why this happened, in my view, it's because the SEC was out to lunch. Lawyers and bankers and the people generally involved with doing the transaction didn't have a reason not to abuse the market. Um, and so they did. And they could chalk it up to a lesson learned in the future when many of these deals inevitably failed. I'm thinking a lot about the automobile manufacturing and electric cars, and just how many we saw of those. I can't remember the stat, but it was something like the total market cap of companies that were being SPACed was equivalent to all the rest of the car manufacturers, excluding Tesla, that were already in existence. Which, look, many people would say that Tesla's valuation seems weird given where it trades, you know, relative to the rest of car manufacturers, but that seemed to be otherworldly, or other galaxied. If Tesla's is otherworldly, I've never been involved either way on Tesla, but you know, we all know the controversy there. Go ahead, sorry, Jack.
I'd love to ask. Look, most of these constructs, they're obviously you laid out issues, and when certain mechanism or regulatory bodies that are meant to help protect investors, if the innovations are outpacing their ability to keep up, it's a sort of, I think, what's implied or suggested by the out to lunch comment around the SEC. But the origination of the concept of the special purpose acquisition vehicle, it has utility.
Absolutely, it
Does
was
it
born
not?
out of virtue. That's
Yeah.
sorry what I tried to
So
say
let's
at the
so
beginning.
let's talk a little bit about that virtue for me. Like, what's the virtuous reason for them?
Is that
Um,
so? It is in the public domain. They should have audits so that it limits, where a blank check company would have been in a private vehicle. The person that ran that vehicle could have done whatever they wanted with that capital. With the SPAC, it's more limited in what they can do with it until they spend the money on the target. So there is
Correct.
some virtue there.
Well, because we're going to touch a little bit on the GP-LP structure, but that virtuous aspect of a SPAC is meaningful because, as you'll hear in the GP-LP structure, once you wrote the check as the LP, you have certain constraints governed within an LP agreement, but otherwise, what management does at the portfolio company level where your investments are being deployed, you're basically trusting another entity to manage it, right? So there is virtue behind it. I think what I'm hearing from you is where the clear incentives get skewed and the motivations of particular parties around the transactions, because these transactions have now reached sizes of pretty significant levels. I mean, you're looking at, I think one of the more recent ones I was looking at is almost a $60 billion transaction value captured within the overall investment structure. You're like, well, that's a lot of money getting divvied up among people that have, once it's done, they're indifferent to what the future performance of that business is.
Right.
And that's not to say that number is too high, too low, or indifferent. It's just, if you don't have transparency into what's happening, that's where these things have become really complicated.
Well, I think you can't say it's high, right? I mean, for bankers who make 2-3% on a debt deal, 7-8% on an equity deal, maybe less than that on a secondary offering, 7-8% on a IPO. This is north of that for a SPAC. So they do get paid a lot. I mean, I think
one of the arguments in favor of SPACs is against the take that traditional IPO banks have had, the value that they extract in the process. Do you not buy that argument?
I don't buy that argument. I think it's time to market is much faster, and so there's a positive there. I think the roadshow gets cut out, or is abridged at least, and so there may be value there.
Even the pricing mechanism of an IPO and the reserve that the bank keeps, and the right to purchase, all those are mechanisms by which value is extracted from ultimate shareholders. But you think that those structures are in place for virtuous reasons as well?
Do I think that a typical IPO has? Yes, I do. Yeah, I do. Look, I mean, for people that are investing in something to have the ability to diligence that thing that is being invested and have the opportunity to do so and do it on a level playing field with everybody else, there's virtue in that. That I don't think is true in a SPAC, where the target can talk to whoever they want, saying whatever they want, whether it ends up being close to true or not. Whereas, in a traditional IPO process, you can't make any of those statements. And I think there's a lot of virtue to that.
Yeah, I agree. I mean, so I wanted to get at the virtue of the SPACs because I think they weren't formed out of nefarious reasons. They were formed for a reasonable purpose to solve a problem. Those problems are legitimate to try to solve, but that in comparison to timelines of kind of the process that's been established and developed in place for IPOs, I think one of the things you find is longevity of a transaction type lend itself to credibility to that transaction type. You just figure out where all the kind of nooks and crannies of bad actors and bad behavior can occur, and it's relatively more transparent in terms of how it's running out. And we're in a space now, as you said, on the hype curve of SPACs, where regulations and regulatory state are behind the kind of curve of the innovations of the transactions themselves, and therefore there's just more shadows that are allowing people to unfairly extract value.
They appear to be catching up. I mean, there's been statements out of the SEC that they're looking into this a lot more stringently than they did over the past 4 or 5 years. But look, it's the incentives that make things problematic. I mean, you go from 0 to 1. That's a huge jump, even if it's just 1. But
when according to the internet, whether or not you want to trust that as the resource, the first kind of officially debuted SPAC, when it occurred?
Forever ago, 2003, 4?
2003. You know when the first IPO was?
16 something.
1602.
That's
Dutch East India Company.
I couldn't remember that.
That's a couple 100 years of experience of one process of bringing a company to market for the public to buy, sharing information about that so that people want to own the investment in that business.
Yeah, but that's not fair. That's not a fair dichotomy that you're setting up. You're like, hey, these are 2 different animals. They're not different animals. It's an animal when one of them has its leg chopped off. I mean, that's
what I'm arguing is that there is I'll make the same argument in the venture capital space. If the longevity of the investment structure and model allow the norms around it and the performance of those investments to play themselves out over time horizons, that let everyone understand what's actually happening. And the SPAC movement has happened where I think there's going to be a fair amount of losers, as you said, that
Yeah, but
may
okay,
not have
so
expected that.
so I think it depends on what the SPAC is being used for, right? So again,
So let's
the
talk a
incentives
little
are
bit
all
about
wrong. Yes,
let's
let's
talk
go
a
there.
little bit about that.
So the incentives are tough if you're just trying to bring a company public, to me, right?
Right.
If we go
We've
back to
talked
the
about
blank
this,
check,
yeah.
if we
Yeah.
go back to the blank check company, it was to give the this, let's use the same terms, the sponsor there, latitude to go do whatever they wanted, whether it was a private company or a public company. Whatever he saw as a good investment or she saw as a good investment, she could go out and buy and run, and hopefully good things would happen. So how do we fix what the SPAC is doing wrong right now to make it a viable, because it will be with us forever, to your point. I think one, you can make sure that people aren't paid to close. I think that seems reasonable enough, and that's something that can be demanded by investors. Or the SEC can hold lawyers and bankers liable and make sure that they make sure that there isn't fraud in the system. I think that's also valid. I mean, when Michael Milskin and Boesky during the junk bond crisis of the 80s were disbarred from maybe disbarred is the wrong term, but they were prevented from participating in the securities industry as a result of their roles in whatever happened there. And that was later, I mean, I think that's sunset, and so they're back. They've paid their debt to society, but doing something similar to a business will prevent people from engaging or from not engaging kind of the fraud checks. I know in a couple of these cases, it's alleged that the bankers knew that something was going on and just didn't pursue it because it wasn't in their interest to pursue. That's alleged, but who knows? But it wouldn't be surprising if that were true. The incentives suggest that would be true. So what's the next generation going to look like? I think there's two ways to think about it. I think there's company linked SPACs, where companies launch SPACs to set up a new growth platform, whether that's one acquisition or 10 acquisitions, to set up a new platform where they don't get paid, where the company then has to live with the transaction and the board has to live with that transaction, where investors are likely to lose their ability to vote the transaction up or down. They can still get redeemed on what they want, but they can't vote down the transaction. But the company, by virtue of its sponsorship, will have 20% of the equity, and they're acquiring the company for venture-like reasons or non-venture, where they can use their manufacturing expertise or distribution expertise to extract real value.
Correct. From a strategic business standpoint, the reason a company would do this is it's an adjacency that they think is strategically important, that they want to have a particular investment or bet on for 3 to 5 year time horizon or whatever it is, and it's not part of their core business.
But it could be, right? For a company, that's certainly the point of.
That's why you say it's an adjacency that could become core, and that's the reason that you want to pursue it.
Well, I think it could be core from the beginning, right? They already get a 20% stake at the top once they buy it, and then they can decide if this is if it's going well, they can buy the rest of it in. If it's not going well, they don't.
Then in that way, it actually outside of my construct came from the venture space. I know certainly that any companies looking to invest out of kind of a corporate venture fund are looking at adjacencies. So and they don't want things that conflict with core, because their view is, well, I might buy that in the future and I don't want to be buying my own money. The SPAC seems to be.
I don't understand that comment. Why not buying your own? Because you still have 20%. You're just buying what you don't own, which isn't.
This is a venture. If I had a venture fund that was then investing in businesses that I knew I was, going to pull in and acquire, depending on what level of investment I'm putting into that business, but I'm doing it at arm's length where I don't have any control about the direction that business is going in. So the SPAC actually, as you described it, and I actually agree, fits in between a division and how a division might think about an investment outlay against core business at GM, let's say, and let's say they don't have the capability skill set. I think that's the argument around one of the more recent SPACs I was doing some deep dive into. They just don't have any of the engineering capabilities and data science capabilities to figure out what to do with the mountains of data that they have. But they know it's inherently going to be important. So they're like, well, I could invest and scale up an entire engineering and data science department. Maybe that does make sense. But man, that's a lot of money to lay out right now. Whereas I could capture in a SPAC through maybe a partnership with a company that does have that skill set but no industry experience, a way to actually pursue that topic area. And then I have a call on it in the future if it plays out. And ultimately, if it's a longer time horizon, I've mitigated kind of the investments. Whereas if I'd done it all internally, it'd be more problematic. And that's different than just some external venture investment, which is even more arm's length and more distant from the company. So I agree. I like that space of this is where a SPAC can be useful, and also where the norms around what that looks like and the transparency communication to investors, both on the sponsor side, which would be part of the company, right, as well as on the SPAC side, become a lot clearer and easier to execute. And then the incentives are also really easy to understand. So I like that use case.
So the question to my mind then is, what is the best use case within venture capital land of what should I be like? I have two vehicles that I'm being pitched at the same time. I have $1 million to give to either one. What are the terms that I should be looking out for that matter in a VC fund versus a SPAC?
Well, I think we started this and I don't want to do it a whole, it's not about teaching, and people, there's plenty of well-written documentation around deep dives on venture structure, but in general,
yeah,
if you are starting a venture firm, you're going to have an LLC structure, and you're going to have LPs. Those are limited partners who are writing the checks. Let's say it's $100 million fund. You're going to have 10 LPs that wrote $10 million checks apiece, and they form up the LP. There's a general partnership that forms and is in charge of making and executing the fund and making the investments. And that general partnership contracts with the limited partnership entity to manage the money. And usually the structure is what's called the 2 and 20. So it's a 2% management fee. So in a $100 million fund, that's usually 2% per annum over the course of the fund. That has de-escalators once the fund's deployed, because their arguments are, you don't need as much management fee because you've already deployed the funds. And all of that management fee gets paid back as part of the returns, which are all governed under the LP agreement.
So in that case, it's not different from a SPAC that gets the 20%, where the sponsor gets 20%.
So, but you don't get the way the LP agreements are typically structured in the 2 and 20. So the 2 is management fee, 2% management fee that comes off the top, that covers the salaries of the people in the fund, the operations to run the fund and make the investments, whatever you're going to be doing to do that. From the administration to the printing of the paper to traveling to hosting dinners with the companies you're launching, to going to the board meetings for those companies, whatever it is, that's all governed under the management fee of 2%. The 20 is what's called carried interest, or the carry. And how that functionally works is the LP typically gets at least 1x back of their capital they invested. So of that fund that's 100 million, which 10 LPs that invested 10 million apiece, each of those LPs should receive back their 10 million apiece before management gets anything above the management fee they've gotten. So let's say it's a really poor performing fund and they just exit at 1x and they get 100 million back. Well, the LPs will get back their capital, management will have gotten their 2%, and there's no carried interest to split. Anything above kind of the certain threshold then begins to be split 80-20. So, you can work out the math, but essentially typical funds are expected to return 3x. So a $300 million return would return 1x at full capital to the LP sponsors, and then 80% of all the profits above that.
Sure. But so I guess I'm making or asking a separate question, which is, when is being in the GP-LP structure ever better than it is investing in a SPAC doing something very similar? I mean, we'd have to be thinking about when things go wrong, right? And so,
So, I mean, the problem you have with when things go wrong, you don't know if you have a good, let's say it's a first time fund. You don't know if those investors are going to be any good for 7 years to 10 until the fund pays itself out. So like it takes 3 to 5 years to deploy that 100 million. And these businesses that if it's $100 million fund, they're early stage, right? Because if you figure your outlay is no more than 10% of our fund can be outlaid against one given investment, that means you're not investing more than 10. It's less than 10 once you less out the management fee, but just call it for simple math, 10 million per investment. That means you're writing no bigger than a $4 or $5 million check to start, which automatically puts you as kind of in either co-investment categories of larger Series A or leads of smaller Series A. So you have a 5-7 year time horizon on those investments, even if they're good, before you know if they're good. So if you're a GPLP in a new fund and you and I started the fund, you don't know if we're any good or our investments are any good for 7 years to beyond.
right. But let's assume it's not a first time fund. It's a second or third or fourth.
Second, third, or fourth, you've got historical performance, right, against benchmark and market, and they just
But that would be the same thing as if I was running a SPAC, right? So, I've got two second term funds. One guy decides to go SPAC. One guy decides to do GPLP. I'm trying to compare these two, and they've got similar returns. They're both.
I think if you could iron out the kind of absurdly obvious bad actor SPAC behavior, the transparency that you get from that, if there were some norms around what the structure should be, which I don't know if we're quite there yet, it actually it might be more preferable because you have a clearer picture on it, and there's different ways to exit it sooner if you don't like the way things are going.
Right, and I'm just thinking. So I know, most funds, the interests aren't transferable. That's not true in a SPAC, right? If you can find a buyer for your shares, even if it's
correct,
you can do that.
Funds typically don't resell. Management can resell on secondary markets. That's certainly been the case, especially in some of these businesses that have stayed private far, far longer. And the funds can take investments out. Let's say Uber stayed private for an extended period of time, right? These businesses that stay private longer present unique challenges to the companies and venture investors that were in it really early. So you can try to take some money off the table at certain investments, but typically not. Management can resell in the secondary market, but you won't see venture funds. They're typically restricted from doing that.
That's right. It's typically in the docs that they can't transfer those interests.
Well, that's the interest that venture firms have had in SPACs. You laid out your disapproval of SPACs as a mechanism for exit of venture firms because you've got a private company that may have been private for 7 years, 10 years. You have no idea. They are holding, I think your line was, I don't want to play poker against somebody who is playing a hand and they know what my hand is and I have no idea what's in their hand.
Right.
And that's part of the problem of the exits, using SPAC as an exit. But venture firms use all different mechanisms to, an example of problematic exits, which they can do. So, funds will develop and build follow-on funds. So the follow-on fund can be dedicated to the second fund, which is structured under 2 and 20, can be for growth of my funds 1 and 2. I have 2 funds already. I'm starting a third. The third fund is meant to help growth capital to 1 and 2. In that way, I guess your LPs are buying into the portfolio and the story of those growing. But in another way, you're just kind of reinvesting and kind of moving those same investments along with your own capital while management extracts a 2% fee. Obviously, they all want to perform well on the returns, but in the meantime, as you stack all those fees of multiple funds, and the bigger the funds get, the fees get larger, you end up with a really kind of perverse mix of how those investments are being managed and what those returns look like. And so I think it can get really complicated. Your venture firms are pretty transparent about the way they operate and the way they work. But it's an interesting asset class, to say the least. It certainly is, over the course of time, developed relatively standard norms. You don't see much variation on the management fees except down. Some of the larger funds have slightly lower management fees. If you've got a $1 billion venture fund, you can probably get by on a 1.5% fee.
Is that all it's gone down? That's all the compression they've dealt with?
They have not dealt with much compression at all. No. The way they typically get it is like you can draw that 1.5 to 2% for 3 to 4 years, and then we we de-escalate it to 1% in the out years, because you're going to be stacking another fund on top of it. And presumably the argument for the management fee is it costs money to find these investments and make these investments. That's at least been the principal thesis. As an asset class, it needs development, because in the more recent years, the durations and times that these investments have stayed private and stayed out of the view of kind of audit view, and I think is a unique challenge to the asset class. And then I think that the size of the funds have necessitated a certain shift in the way the investments have taken place, certainly in the software space. That I think presents a unique challenge too. It's a little different in the life sciences space, but
why is it different? How's it different? What's the difference?
Life sciences venture capital typically has much larger rounds earlier on, but that's because they're investing around hard IP. It's a CRISPR technology, sure, right? So
right.
Or it's some drug that's going to go through a relatively standard expectation of development, of drug development, right? And you've got an addressable market related to that drug. The constructs in that space haven't evolved as quickly as they have in the software space, where every software company is kind of modeling off of a Google, Facebook type of experience. And I think that's problematic. But in life sciences, the rounds tend to be bigger. You can get bigger rounds even as an A against really sound scientific founders with really sound IP that are getting A investment rounds of 15, 20, 25 million. The venture firms are taking a much larger chunk, and the life sciences firms are much better equipped with expertise that actually help develop that business. And I think that's the difference of life sciences investing in biotech than what we're seeing in the software space. I don't know if I buy how much value the software investors are adding versus the kind of core team.
Right.
Like it's one thing to have a scientific founder who's discovered a small molecule, but has no idea how to run a clinical trial. And then you have that skill set at the fund who knows how to run and deploy a clinical trial because they've done it at Schering-Plough or they've done it at, Merck. And now they're part of that investment group. And so I just think that the functional skill set add out of that group is far easier to understand than the software argument around skill set add, which is, talent recruitment, go-to-market strategy, customer introductions. Like those feel less tangible than I'm going to help you actually scale and run a clinical trial.
Right.
And so life sciences has been very different than the software-based one. So both. I think life science is much more equipped to. So when I say the model needs some rethinking, I think it's more on the software and IT side that have some questions around it.
Right. So it seems to me though, like for life sciences in particular, then the SPAC model really, it's like a good one, right? It's generally good for venture capital. That for me as an investor, me as an LP, investing in, Jack Stockert's life sciences venture capital firm. I prefer a SPAC structure than a GPLP. You're going to need a lot of capital up front. I get the transparency. I don't see any drawbacks really. I mean, as long as I can limit how you spend the money initially and put in some new terms so that there's really no incentive for you to just get the deal done.
No, if I'm competing the two deals against one another, the question is going to be, does an inherent venture, life sciences, biotech venture fund have a core set of competencies that are repeatable, that are harder to scale more immediately within a SPAC given model, right? So, are there 7 employees within the venture firm who are going to effectively serve as the operating team of their investment, and they can do that across 3 or 4 different companies of similar type versus one. So I think you'd get portfolio distribution of risk.
Why couldn't they do that anyway?
What do you mean?
So if I'm the SPAC, like the SPAC is set up such that instead of making 1 acquisition, it makes 7 acquisitions. That's it.
Yeah. Although I think there's 2 aspects to portfolio. One is the risk spread across a variety of different assets unrelated to one another.
Yep.
If that's what you wanted to do, I probably would trust I think the venture model would work more effectively than I would think that the portfolio argument of related assets within a SPAC would be more important, at least as perceived by the market in terms of early performance. It'd
But
be
we don't have to worry about the market, right? Because this can be closely held, right? It doesn't have to trade it on exchange and be marketed towards individual investors and looking for a pop. That's all stuff that we've been doing over the past year and a half or 2 years, but it's not, it's not part and parcel of SPACs generally. SPACs are, as we've talked about before, just a function, right? I mean, they're just a construct.
Mhm.
So why not have a SPAC that's set up just like a fund? They can invest along 10. It can be in disparate properties. We get our money back the exact same way. Those are just terms.
Yeah.
Ultimately.
No, there's an argument. I see your point. I don't have an argument against it. I think that, I think it's, yeah, I don't have anything to add.
Okay. So I mean, so that would be advantageous though for an LP. Like, can you think of anything that
I
is
think it depends on the
negative?
type. I would think of it depends on the type of LP you have.
Okay. I mean, I just don't know enough about how the LPs look at it and it's bad for the GP because it's less lucrative. But otherwise, is there anything that I'm missing for the GP um, with that
I,
construct?
I mean, the GP would prefer a stable management fee stream absent fund performance. I would think.
Again, you can put that in the docs, right? You can say, hey, we're going to get 1% is going to be the fee, or 2%, whatever is going to be the fee. It'll be in this as other expense line or professional services line or whatever you want to call it.
How is that income treated? I don't know that. I know that the GP carried interest is obviously treated as carried interest. In a SPAC model, is it treated the same?
I don't, there's a pretty decent chance that carried interest isn't going to matter that much in a year anyway.
Well, hey, that's a
so.
well, that would be interesting to understand that question, which I don't.
I don't.
Perhaps because I would see. I guess it depends on the time frame, right? If you're holding the kind of equity position and your incentive structures are beyond 1 year, it probably at least current time would be treated under carried interest. But I don't.
Right.
I don't know.
So that gets us to the same place then. It's interesting to me.
I think venture capital likes venture capital model because it's a stable management fee stream from a traditional GPLP structure where performance is a little bit pushed out and there's more flexibility to do what you want to do and to pursue the parameters under which the LP agreement governs kind of rights. Having kind of reviewed these, they are helpful, but they more or less give you a blank canvas versus I think a SPAC is going to have to come out with more of a paint by numbers constraint for how management would work for it to have effective interest from an investment perspective. I actually think that's better from an investment perspective, but the venture structure gives a level of autonomy to those general partners that I think if you really understand, you begin to wonder, why would I continually put a significant amount of money into that asset class?
Okay. Got it. So the transparency is bad, except when it's an asset that they don't really want. It's great. We'll throw it in this back.
I think the SPAC is a way to exit appropriately businesses. They exit businesses differently too. You'll have portfolio companies buying other portfolio companies and integrating because they didn't have a pathway to exit. That's equally as, I would think, more problematic than exiting through a SPAC.
Well, in one case, you are exiting to other investors who are accredited, and the other way, you're not.
Yeah, you're just like you and I started two businesses. One of them's not performing the way we thought it was. The other one's doing pretty well. And we just tuck that one in under and then extract some of the investment from it. Now, That's obviously happening in downside scenarios. There's no way you would ever do that in an upside scenario.
Yeah. Management can't push back. Management that's getting screwed there can't push back. And
it depends on how much management's been diluted down. Typically, some of the covenants on these businesses, if you've taken a down round, allow the investors to pretty much recap businesses and own them, or at least control them through the preferred.
Do you know any of those companies that went public where that happened to them?
I know a few that have happened. I don't know if I don't think the acquirers that I'm aware of have gone public yet. I also know of ones that went public and then acquired portfolio company of the same fund that was a holder of the investment to originate. But I won't say names off the top
Of course
of my
not. No. There's no reason to blame.
So, that's just another version. So you can have two privately held companies which have the same investor, and one's being tucked under because obviously the performance of whatever is not going as great as they wanted it to go. And there's a synergy growth argument for the other investment that's, saying, hey, if we pull this whole team under here, link them, sell within the same channel, now all of a sudden we've got a rocket ship, and that's better than this business failing. And that's going to help the core business. That's one model. The other one is this business has gone public, already generated some return, and it's going to then buy, because some of the management and control are still held within the core investors because they don't typically exit immediately, and they buy a portfolio company that existed from that same investor. That one at least is done in the transparency of the public market. So if I own the already public entity, I'm evaluating it. But
yeah, but it's not, because this would be considered a de minimis transaction where they don't even need board approval, right? I mean, that's the whole point, is that these are $2, $3, $4, $5 million acquisitions. They can't be that material. Well, I guess they could, but it's unlikely for them to be material if they're already failing in the private market.
Yeah, but the problem, and then this presents why I think the model is risky or almost is nearing being broken, is because these companies stay private far longer. So it's not 4 or 5 million anymore. Right. Yep. You've got businesses that are 20, 40 million, 50 million, right? So
yeah.
And yep. I think the software and services businesses space, it's more complicated. I think the life sciences space I have less concern about.
Got it. Okay.
Because if you have an asset in that space, it's an asset with a market, or it's not, and no one's going to be buying it unless it ties into your portfolio, and you have a delivery platform that would be beneficial for the given target. Anyway, that space, which I'm less concerned about, it's more to the software services side that it becomes problematic. We talked some around the utility of SPAC in the venture land, but I think we dove into kind of where it can be misused, and that's around kind of exiting investments which may not have performed successfully or beneficially through an IPO exit market, or have no interest from an M&A market. So meaning SPAC became option 3 for a venture firm looking at its portfolio, saying, well, I can't find anyone to buy this, any significant kind of corporate or public company sponsors to buy it. I can't exit this through an IPO. So now I'm going to exit this through a SPAC, where I'm able to kind of sell a vision story, of which I've been selling the whole time, which is why I was making the investment in the first place. But it's not so. I worry about a SPAC and venture as a means to an end around exit. I think what you proposed and what we talked about briefly was the use of a SPAC to perform venture capital type investments as a model for an LP. And so two very different use cases. I think the first is a really compelling and interesting kind of line of thought, which is, as an LP, if I look at both of these assets, which one do I like better? Provided that I don't have to have increased management or oversight, and I don't have any additional exposure than I would have had as an LP in a typical GP LP fund, then I actually like the SPAC as constructed as a model for venture. And to me, it's a continuation of your first example. So if I'm doing things that are core, in your first example of a company sponsored SPAC, a venture SPAC with a LP as an investor into it is just a next step along that continuum, and I think a beneficial one. Where it's problematic is on the side of if venture firms are utilizing the SPAC as an exit scenario. So that's a different use case in venture. So we should just be clear on parsing apart the two. One was an LP view, where yes, if you constructed it right, it could be as advantageous or more so, because you could tie performance more acutely to management and investment. And then the other angle that you had was from the sponsor side and who's sponsoring the SPAC, and and that's where it can be. I would stay away from, as we've discussed extensively in the past.
Yeah, as I think about it too, it seems to me both for the LP and the GP, you would still have to have public financials for the SPAC. That seems to be problematic, given a certain level of disclosure. If you keep it more opaque, I suppose it's better for potentially everybody involved, particularly as if there are 3 or 4 investments, and therefore it can be kind of averaged out. You can't look through to a specific investment, but you're still at a level where competitive disadvantage can be a really important problem, right? I mean,
yeah, I think that the onus would be on the SPAC in that first case to clearly define what its thesis space was, probably more specifically than traditional ventures had to define their fund type. Like I can raise a fund that's focused in, digital health, right? And so like, okay, well, that could mean any one of 1,000 different investments. Could be data driven, could be software driven, could be, a mix of like biotech, life sciences, whatever it might be. I think you'd have to be more focused in your proposal from a SPAC perspective, but that also might tip your preference towards that type of model because, if you're an LP,
well, I'm saying as an LP,
trying to do.
I don't necessarily want my GP who has made an investment of a company that has $1 million in revenue. It's not seed, so we're past seed at this point, I think. I mean, you tell me, but he's still, you would have to say what that company A is and exactly what they do. And now we know that they're growing 10% last quarter. That could potentially be something that is reflexive and hurts their ability to perform in the future, because competitors can spot, company A's performance and say, oh, we think that growth was from, customer B, and we're going to go try to steal customer B, and then they don't have, the ability to continue to exist because they can't generate cash flow, which we know what it is.
That does raise an interesting point and challenge. A lot of the early stage companies, the sophistication and level of their kind of financing and internal finance and controlling capabilities are just, they have not needed to be and are not at a level of auditable public financials, right? Usually you bring in your publicly experienced CFO when you're thinking about going public, and you pull that stuff together.
Yeah, but there's different bars for different size companies, right? I mean, if you're under $1 billion, for instance, it's a whole different auditing structure than it is if you're over $1 billion. I mean, that's a real thing. Okay. So I don't know where it is under $10 million and what would be or whatever, 10 million in revenue. I don't know what that means. I would imagine though it's not, at the same level. But I'm saying so also on at least, large public company, you don't really have to disclose unless it's 10% of revenue. So, as I'm thinking about how would I actually implement one of these, I need to announce 10 acquisitions of 10 different target companies on basically the same day. And that would be
really difficult to do.
Right, exactly. Or 3, or 4. The point is that people from the outside can't tell what one individual investment is doing, even though that they know the name of it.
Yeah, well, I guess the question is, could you construct the SPAC to allow you to
do that? I think you could, right? I think you can do whatever you want to do as long as it's public and you're honest to it.
Because that example of the $100 million fund, no more than 10 million in any given investment. Yeah, you could lay out that same.
Well, no. Like I'm just saying, like Google, for instance, didn't have to break out what YouTube was until it reached a certain size, and then I think they had to. I don't think they just decided to. I could be wrong about that. And you see it over and over again. I'm using Google because it's
well, where I was going to go with that is the 10 investment $100 million fund example. I have 3-4 years to find those 10 investments, and I can find 2 on day one in day 365, one 3 years in, and so forth. And I think how you thought about constructing the ability to do 5 to 7 investments simultaneously would be an interesting,
I think it would be
interesting.
problematic. No,
I,
look, there are a lot of advantages of opacity that I think are often overlooked. Um, and I'm saying opacity is good for the LP, not for the GP, right? Whether it's in the private markets or in the public markets. Me as a fund manager, a number of my clients get um, excited when things are traded when they should be, and others get excited when things aren't traded and they feel like it should be. So you put a blindfold on and everybody's better off. Um, Nobody gets excited ever, and they just see the returns at the end and they're happy or they're not happy. But they don't have to be excited in between.
and I guess the point on venture is that to an extreme. I'm writing you a $10 million check, and I won't know if that's worth 30 million until 5 to 7 years from now.
Yeah,
And the argument would around a SPAC as a viable model in this space would be: can you construct a version of it that allows something better than that?
yeah, yeah. Um,
I think you could do that in a roundabout way, right? Comes back to, maybe this is the way to close it out. But we started with one of the big issues that's happening in the hype curve of SPACs, and the problematic situation is perverse incentives across all aspects of it, and how those incentives skew actions that benefit one party at the behest of the investor, I guess, at this point, the person who would hold the asset. Um, if you understood the constraints and laid out clear expectations of what positive performance meant and what negative performance meant, and a kind of a time frame for that, but then left opacity in the execution, that would seem to be okay.
yeah, I agree.
I mean, that's what you do with your fund.
Right.
You just do something similar.
Yeah,
So
I agree.
this gets at, like, you're right. You don't want so much transparency that your LPs are seeing the 3 investments that you just pulled in and the 3 more that you're looking at. Like, you don't need that level. That'd be problematic, I would think,
Right.
both
Right.
for executing the deal itself and the idea. Seven simultaneous small growth business investments at one time sounds like a headache to me.
How many do you think you could? I mean, the question isn't announced, but close at one time. What's viable there?
What size of investment are we talking about?
Not that big, right? I don't know.
It'd be hard, because the moment you're talking about anything kind of above, anything below 10 million, you're saying, I have a simple rubric that I think about in terms of acquisition on the venture and growth side. So anything under 10 million, you're just buying team. Anything 25 million, you're buying prototype of a product. Anything at 50 million, you're buying a product at some level of customer. Anything at 250 million and below, you're buying a business, but with only kind of one product pathway. Anything kind of upwards above 250 million, you're buying a broad kind of product pipeline, portfolio, team, and execution. And if you're the selling company, the only reason you should sell for more than 250 million is if you think the prospects of your market are such that there's no way you'll ever be bigger than the people who can acquire you. Now that math shifts a little bit, but you saw that, and that's the reasons why Google and others, I believe, declined the Yahoo overtures of acquisition very early on. It was because, look, if I can win this, my market is going to be so much bigger than what you currently have that I'm going to be in a position to acquire you. So that's the calculus at the high end of spend. So if you think about checks that are written for 25 million and under, or 10 million and under, you're just buying team and limited product. And
even better than, right, for this case, and that's amazing.
So that works. Agreed. Once you get above that kind of threshold, you're going to have enough institutional investors that I think these deals become harder to close. And so the sweet spot you'd have to be looking in is kind of that 15 million and under area. And then those businesses, you're looking at mainly team, a thesis around the market. Maybe they have a prototype, maybe not. Maybe they have revenue, maybe they don't.
It seems ideal if they don't, right? Or if a team that you already have is about to start generating revenue, and you make that second acquisition. So then people don't, then it's hard to know from an outside perspective. Forget about the LPGP, but from an outside perspective, which one of those is generating the revenue?
Correct.
Yeah, that's interesting. That's interesting.
You know what it is? Maybe in a future cast, we explore the implications of kind of what's a series. If you look at a series of investments in the 5 to 15 or 10 to $20 million space, like you can get a sense for what types of companies those are. Like,
Yeah.
right. So I would think that I would want to be looking at targets that have relatively minimal to limited institutional funding at that point.
Yeah.
Just because I think those if you've got a traditional venture firm involved,
Yeah.
there's no way they're after home runs, not singles, and this would represent an exit after, $10 million would represent a single.
Got it. All right. Well, let's wrap that up here.